We cover many hated stocks that are beaten down on the channel with very bad sentiments. They tend to be the most volatile. They tend to go down a lot initially, and then the recovery is normally very fast and very steep to the upside. One of these stocks is Disney. It's up over 7.5% today after reporting earnings. This is a pretty amazing move after Disney was trading pretty close to its March 2020 low. Absolutely insane. This is a joke I made on Twitter, is that you should mainly be bullish whenever seeking alpha authors are fearful. And not just seeking alpha as author, but most people and most analysts, whenever the stock is going down, they downgrade the stock because they don't want to look wrong, so they intend to follow the trend. This is what happened with Nvidia. As Nvidia was coming down, analysts kept downgrading the stocks, people kept bashing on the stock, and once it started going up for a short period of time, analysts did not want to look wrong, so they were using higher multiples and trying to inflate the stock, saying it's a buy, how it's an amazing company, and they kept increasing the price target as the stock went up, not just of any major changes in fundamentals, but mainly from sentiment and price action, because they don't want to be looking wrong. I'm not saying most analysts do this, but this is what normally happens. And if this is a sustainable move and Disney trades at 105, I would dare you to check Seeking Alpha maybe 2 or 3 weeks from now, and I would bet you will see much more buy targets that, they are now bullish on the stock because it went up. So it's pretty interesting what normally happens. But Disney's earnings were pretty good. They did beat on EPS, 82 cents versus 70 cents. Pretty good. Same thing on revenues. They did, miss a little bit on revenue, but it wasn't something huge. Now, there's a lot of improvements that caused Disney to go up 7.5% today. And one of those kind of improvements is the cost savings, because now it's around $7.5 billion by the end of 2024. They increased it over $2 billion. It was $5.5 billion. Now it's $7.5 billion. They are finding many more savings in SG&A and operating costs, which I believe are extremely high for Disney because the company got a little bit mismanaged with the previous CEO. Now Bob Iger is here and he seems to be doing the right thing for Disney, trying to lay off some people. They are not needed over there and cut costs here and there, some cost on production, content spend. So they are finding a lot of savings over there. This is good. This is what Disney needs. And I see Disney being on the right track. And if you look at, one of the most important metrics that people look at is the core Disney Plus subscribers, meaning the ones that are in the United States. They rebounded and it's now 46.5 million subscribers for Disney Plus in the United States. The international subscribers, they are growing rapidly from 59.7 million to 66.1 million, over 6.4 million pretty much versus the previous quarter. And now they are excluding Hotstar, which is a kind of Disney Plus in India. And this was from the cricket, because they had the cricket rights in India and now they lost the rights or something happened and people were canceling. So every single month, analysts would bash Disney that they are losing subscribers. Well, in fact, they were gaining subscribers if you excluded Hotstar. So excluding Hotstar, the international segment could not be better, 6.4 million. The domestic segment is a little bit more mature, so it's not going to gain as many subscribers. But average revenue per user, ARPU, is increasing a little bit, which is good. This is one of the metrics you should focus on in more mature markets. It's not much about subscribers growth, but they are growing fast in Europe and all around the world, which is something pretty amazing. Free cash flow generation has been improving a lot. Now it's around 4.9 billion. I mean, you can see what it was in fiscal year 2019. 2018 was 9.8 billion. Now it got a little bit better to 4.9 billion. And this is what I say. He said, we expect a significant year-over-year increase in free cash flow in fiscal 2024, approaching levels we last achieved pre-pandemic. Pre-pandemic could be something like 8.7 to 9.8 billion. This would be a massive, massive improvement. And this is what the analysts are pricing in. Disney used to make 9.8 billion in 2018, and it got as low as something like $1 billion last year in 2022. Now in fiscal year 2024, it's expected to be 7.5 billion, then 8.6 billion, then 10.1 billion, then all the way up to 15 billion by 2027. I'm not counting the 15 billion, but if Disney can get back to where they used to be at pre-COVID, like Bob Iger is saying, and pretty much in fiscal year 2024, this would be amazing for Disney stock. I mean, pretty amazing stuff. So you could see the big difference in execution. It's narrowing losses in terms of DTC, direct-to-consumer streaming business. This is another important metric. I believe they could potentially be profitable in fiscal year 2024 if they continue on this trend. pretty much bottomed at 1.5 billion of operating loss, and then last quarter was around 500 million. Now it's 400 million. So it's moving to the right direction. You could see the big difference that the CEO makes. Now we have a new CEO, a new face for the company, a new strategy. I mean, pretty amazing stuff. And yet Disney is up 7.5%, but it's still sitting pretty close to March 2020 lows. And there's so much improvements that could happen with Disney, but the market is really not seeing it. And this is my valuation model on Disney, so I don't keep the video too long. I put in 7% revenue growth over the next 5 years from 2024 to 2027. This is pretty much in line with the analyst estimate 7 to 7.5%, which I personally believe is fair. Net income margin, I used 11% net income margin. This one is a little bit tricky because Disney used to make up to 18% net income margins in 2018. I'm not sure if they're going to get back to 18%, but if they do get back to something like 11% over time, as the cost savings start to be realized from synergies, from selling some low-performing businesses, from lowering operational costs and SG&A and stuff, that would be pretty amazing. And I personally believe Disney could potentially get to an 11% net income margin. I'm not betting on 14 or 18%, but I think something like 11% is fair. I use 20 times earnings. So this is pretty much the historical average, around 23 times earnings. So I use 20 times for Disney on 11% net income margin. I also believe this is fair. The dividend is less than 1%, so I did not include the dividend. In total, I still have it pretty much close to my previous video, which is like 78% on the upside or 12.2% CAGR over the next 5 years. Now, if I want to safely double my money with Disney stock, I would have to really buy it something like 74.96 cents per share, or closer to $75. And $75, I mean, it traded pretty close to 75. It touched like something like 77. 75 would be something like what it was trading at in 2014. I'm not sure if Disney is going there because there's such bad sentiment and the stocks tend to recover pretty much sometimes above fair value. This is what happens with a lot of them, especially the higher quality names like Disney, which is becoming high quality again. And there's a lot of improvements. I'm pretty excited about it. But this was my fair value on Disney. I like what the CEO is doing. I'm not sure if this move is sustainable or not, but this is short term. Most of you guys are in Disney or are interested in Disney, I believe, for the next 5 to 10 years. And the company is looking much, much better. And I hope the CEO keeps it up. It's pretty exciting stuff. I don't know much about the strikes and all these kind of things in Hollywood, so I'm not going to really comment on it. But this was my opinion on Disney. It was not financial advice. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.